Hi everyone and a very warm welcome. Auto industry in India is the world's fourth largest. We are the fourth largest manufacturers of cars and the seventh largest manufacturers of commercial vehicles. There has been a lot of focus of Make in India and research and development as far as auto sector is concerned. Though all the fundamentals look pro the sector, we have seen the stock market returns showing a contrary picture. There have been a lot of roadblocks for this sector, starting from GST, insurance regulations, pollution norms, so on and so forth. To understand this and much more nitty-gritties about this sector, I am joined in by a subject matter expert, Mr. Sachin Trivedi. He is a fund manager and senior vice president with UTI AMC and is also a CFA charter holder from the CFA Institute USA. Sachin is responsible for managing the UTI Transportation and Logistics Fund. Sachin, many thanks for joining in, and I hope you, your family, and everyone at UTI are doing well.
Yeah, sure. Thanks the team for actually giving me an opportunity to come and speak to you and through you to your investors. Thank you.
I said in my opening remarks that fundamentally speaking, everything looks to be working for this sector. But in terms of strengths and opportunities, how do you see the auto sector being positioned at this point in time?
Sure. So yeah, like in your opening comment also you stated that from volume perspective, maybe we come in the higher rank as far as the overall volume is concerned. But then we should also keep in mind that this is so in terms of volume obviously makes sense because in two-wheelers we are the largest and maybe after us there is a Chinese market which is as large. So maybe we would be around 18.5 million and the Chinese would be approximately 16 million. But then the larger piece that is where we are highly under penetrated is the car market. So maybe the global car market would be approximately in the range of 80 million, and we have peaked at around close to 3 million. So, and plus on top of that, three and a half lakh rupees. The cheapest car maybe in India would be around 6.5 lakh rupees. So why it is important? It's important from the perspective that not only that the penetration for the Indian market has to improve, but also we have to move up the ladder in terms of the kind of vehicle that we use. So that's where there is a huge opportunity as far as Indian automobile sector is concerned. So again, what we will gradually see as the income per capita income for the people improve, there is an expectation that people will graduate from two-wheelers to the four-wheeler first in the entry segment, and later on they will keep upgrading it. So that's the pattern that again we have seen also in some of the middle class pattern, which is where they first adopted the entry level car, then the popular choice was somewhere in the mid range, and now they are gradually upgrading themselves to the SUV. Similarly, within the two wheeler also you see the same trend, is that from just from the entry level segment, the people are gradually moving up to 150 200 cc, and now they're also making a choice for whosoever can afford to go to 350 cc and above. So these are some of the trends that we have observed, and these are some of the opportunity for us from the global perspective. Now you have also asked me about the strengths. For sure, for the Indian market, one of the key strength lies in the entire vendor base that we have developed over a period of 3 to 4 decades, and that's where the big opportunity for us lies. Not just for India, but also for us to make in India and maybe export big amount from India. So that's an exciting opportunity for us.
Right. So, in terms of the macro perspective, it definitely doesn't look all that gloomy. But coming to specifics and speaking, more so in the current scenario, context of current scenario with the increase in Indo-China trade relations, we have seen Maharashtra canceling MOUs with certain Chinese companies. We have also seen supply chain getting disrupted, and we have seen increased focus as far as self-reliance is concerned. How do you see the impact of India-China relations for auto OEMs and auto ancillaries, and also the impact probably it can have on pricing, innovation, and supply going forward?
Yeah. So India, see, the one of the trend that we have observed as far as the entire auto chain is concerned is that over a period of time, how our manufacturers could provide an affordable solution to the end consumer is only through cutting down the cost, and that has happened over a period of time by localizing more and more content. So maybe today, if you call on an average for the larger manufacturers, the component, the imported component would be anywhere between, let's say, 15-16% to even high single digit. So over a period of time, that's the source, and actually that's also an opportunity for a lot many auto ancillary manufacturers. So that's the underlying trend which is happening. Now, your specific question to China, obviously there are certain areas where the relationship goes on, and say for example a car manufacturer, so the large premium SUV manufacturers or the car manufacturers would be depending on certain components like tires, which would be because the scale is so small in India, it makes sense for them to actually go and import it from whichever is the cheaper source, but at the standard items. So those are the areas which get impacted. So for just a small component, which is let's say 1 or 2% or 3% of the overall value of the car, that's the entire export area gets impacted. So these are the smaller things, which is where attention need to be paid. That end of the day, does it serve the purpose for the country or not? Now, any which ways, from the OEM perspective, as I said, that the broader trend, they are actually cutting down on their imports and depending more and more on the domestic partners. Now, this journey has also been traveled in the entire industry by collaborating. And by collaborating, I mean to say that in many areas you would have found that these have started in form of JVs, and gradually the entire technology has been passed on to the Indian manufacturers, and they have also picked up very well. And now, with the scale, they are able to do their own R&D and come up with the cheapest solution for the auto OEMs. And this is how the journey has been. So from Chinese perspective, I don't think so. It's a very large import content. Of course, some few specific players get impacted, but I'm sure they have routes to recalibrate their entire logistics piece.
If I'm not wrong, what I read today was that we have got the permission to have tires from China as well. So I think that's a realistic way of handling things. And that brings me to my next question. Something that you alluded to in your first answer as well is that we see high premiumization in terms of bikes and also four wheelers. But on the other side, we also see that 81% of auto sales are actually just two wheelers. So, there is this big gap, so to say, which exists, and probably, with increasing affordability, that would change. So, how do you, in the given scheme of things, see the segment-wise growth for the auto sector?
Yeah, perfectly well. So if you pay the attention to the longer term growth rates, right? So you're right in pointing out that India's large two-wheeler market, and that is more to do with the affordability side of it also, because again, for us, the transportation infrastructure has not been very well developed, and it will take maybe decades for that to develop. But in absence of that, and because of the poor affordability, people are primarily relying on the two-wheeler, and which is where we are one of the largest manufacturers into two-wheeler. And again, in export market also our participation is quite good. But coming back to your point, if you look at the longer term growth rate, again, maybe two-wheeler is close to 8% growth rate, and I'm leaving aside the FY20 because that's distorting the entire picture. But maybe two-wheeler would be a 7 to 8% growth market, and although we would have expected that the passenger vehicle growth rate should be much higher, but again the passenger vehicle growth rate is in the range of 5 to 6% in last 5 years. So that's one level of disappointment. But yeah, our expectation would be that gradually this entire growth rate should pick up. Very near term, obviously, both the two-wheeler as well as four-wheeler market, they have actually come down. So last year, which is the FY20, it has been one of the worst degrowth in last 4 decades. So this 16-17% kind of degrowth that we have seen in both the four-wheeler as well as two-wheeler has been the worst, as I said, in the last 4 decades. And say, for example, in two-wheeler case, the last degrowth that we have seen in last 2 decades was in 2008. That's a global financial crisis. And in four-wheeler, it was in 2014. That's it. In the last 2 decades, that's the only two data points that we have for degrowth. But last year we have seen almost close to 18% degrowth in this market. So obviously, the expectation here is that the segment should go back to the normalized growth trajectory of longer term growth rate of 7 to 8%. But there will also be in interim, there will be a catch up rally. And why I'm saying so is because clearly the data points is also suggesting that the in the secondary market, the average holding period has gone up. So which is at some point in time, this will get converted back, and which is where you will see that the medium term growth rate should be much higher to catch up to this longer term growth rate. When we talk about the subsegment of CVs, again, our observation about the CV market suggests that this market is a 6 to 7% growth rate market as far as volumes are concerned. But this market is a bit more cyclical than the previous two subsegments. And here we have observed that this industry faces maybe a steeper decline of 20-25% CAGR for 2 years once it reaches its peak volume. And then again, it travels back to the higher level of volume. But net, we have seen in last 4 or 5 cycles that this industry is 6-7% growth market. But last 2 years has been actually FY20, and the current running year has been quite unusual, where we have seen just in 1 year close to 47-48% kind of degrowth. And on top of that, again, we have seen that degrowth. So our expectation is that there will be a sharper bounce back in maybe 1 year or 2 years time frame. So that's as far as the CV is concerned. Obviously, there are multiple challenges this segment faces, but again, because there is a replacement cycle which kicks in, so that should be supportive. And the final leg would be maybe the tractor market. Tractor market has seen some amount of degrowth, but again, it's a 6-7% CAGR in volume growth market. And again, the expectation this year, all the data suggests from the rural areas and the current demand suggests that it is back on track to be a growth market as far as this year is concerned.
Thank you, Sachin, for a very, very detailed response covering all the segments. Now, my next question is somehow linked to your previous question in terms of growth. And I'm talking about primarily passenger vehicle. So this is about a shared mobility versus ownership. There's a point in time around a year back when most of the analysts used to say that the car sales, or even to some extent two-wheeler sales, might reduce or might taper because we are moving towards shared mobility. And we would see a lot of people around us using Ola, Uber, and Bangalore has had the fortune of having leading companies in shared mobility, both on two-wheeler as well as on four-wheeler. Now, a lot of analysts now have gone a step back and started saying that with COVID, personal ownership will be the trend and not the shared mobility. So is it more of a recency bias that we are attributing this to basis the current situation, or are you seeing a structural change which might put the growth of shared mobility at risk at the cost of personal ownership of vehicles?
No, so primarily the need for shared mobility arises because Bangalore, Bombay, the two cities also have been facing a lot of traffic issues, right? So the basic need for shared mobility arises because there is basically the cost of ownership of a vehicle is very high. It doesn't give you the flexibility, as well as at the same time there is a fact that you don't get the parking spaces either in your office or in your at your home. So all host of things are is what has given uptake to the shared mobility as far as India is concerned, right? And also it has been funded by a bit of PE money. We all know about that, and which is where the basic economics of the entire shared mobility has to be revisited by some of the players who are in the market. And the basic challenge as far as shared mobility is concerned, see, because the end of the day, the consumer, the guy like you and me is looking for a affordable, comfortable ride, uh, which can serve my purpose. That's the end need. And whether it is through personal mobility or through a shared mobility, we will always keep looking for a solution like that. Now, today, the post-COVID, obviously, there is a desire for people to look for more safer transportation. I'm sure at over a period of time, we will all go back to the normalized thought process, and which is where we will again start to look for more comfortable, affordable solution. But in as far as the shared mobility is concerned, the players will have to actually completely rework their economics as far as the shared mobility is concerned, because the moment you try to increase, because today many of them would be facing availability of driver issue, right? At the same time, the financing agencies are also taking a relook at how they would be financing some of these vehicles. So all these factors will again undergo a complete change, and which is where the new model has to emerge. I'm sure it will coexist as far as the densities are concerned, which is where you need that solution. But if your underlying question is that does it impact demand in a market like India? See, as I said in my opening remarks, is that the penetration level in four-wheeler as far as India is concerned is maybe something less than 3% as far as household is concerned, versus let's say 50-60% in some of the developed markets. So I think we have a lot more room to grow beyond some of our congested cities, and which is where the growth has also been coming for last couple of years. So there is long room for the sector to grow. Just to talk about numbers, some of the larger players have reported at the peak, maybe shared mobility demand was close to 7 to 8% of the new demand, which has come down to as low as 3 to 4%. So I'm sure this will completely undergo a reject, and we will find a new solutions which will appear, and both will coexist.
A very valid point that, at the end of the day, it's more about mobility and the options are subject to the environment you are in. Now, Sachin, my next question is something which has been touched upon earlier also, and that is about regulatory intervention. And I met you, I think, 1.5 years back, and you were quite optimistic as far as regulatory changes were concerned, that, we have had enough of that. But every now and then we keep on having intervention, be it about, high GST on vehicles, be it about excise duty on petrol and diesel, be it about insurance norms, be it about Excel norm. So, it's not only one segment, but the entire segment of automobile has been impacted every now and then. And while we were settling into this phase, we had COVID now, which again put some stress on manufacturing. So there have been industry leaders like Bajaj who have been very vocal about intervention of the government, and now even RC Bhargav and all, they are also saying that government support is required. So is the worst over for this sector, or we would keep on having these kind of issues cropping up time and again?
Sure. So, see, one thing we should always keep in mind, some of these regulatory changes are not just driven by the government. Obviously, government is the final authority to come and ensure that the execution takes place. But some of these changes are also driven maybe because of the court intervention. So, and those are the changes which not just in India but globally also affect these regulatory changes that we just spoke about, be it the insurance norms or be it about the environment norm itself or the safety related cost also which has been enforced. But back to your point, is the worst is over. So I'm sure there is one more change which is coming in 2023, right? So but one thing we should remember that continuous change and continuous upgradation should be assumed as the part of life as far as this industry is concerned. Why this got escalated in last 2 to 3 years for the sector is because in 2016-17 we have seen demonetization, then we have got into the implementation of GST. So both these put together, these factors have, and plus the third thing also should be kept in mind is that the overall inflation environment has also been quite subdued in the country. All these factors have ensured that the income growth, the nominal income growth as far as the individual buyer is concerned, has been a bit of a challenge in last couple of years. And on top of that, the all the changes that you just referred to has resulted in the cost increase of somewhere between 25 to 30%. So both these factors, the slower income growth as well as sharp increase in the cost. So like you just said that maybe there are two norm changes that we have undergone, BS3 to BS4, and the sharpest turnaround from BS4 to BS6. I think as far as that is concerned, we have leapfrogged, and now compared to Euro standards, we're just 3 or 4 years behind. So I don't think we will again experience such kind of sharp ramp up as far as the standards are concerned. So that is behind us. My all indications suggest by talking to a couple of OEMs is also that even this 23 related regulation change which will come into place, it may not be as much inflationary as what we have seen in last couple of years. So I think from here on we should see a moderate increase as far as the costs are concerned.
My next question again is somehow related to what you mentioned, and this is about disruption and environment concern being the primary reason for that disruption. So there are multiple forces at play here. So on one hand, we are seeing automobile manufacturers putting in a lot of investment into EVs. On the other hand, we are seeing a lot of consumers or end users also preferring environmentally conscious vehicle versus the conventional one. And then there is a support of the government also, most of the governments, including India. Now, the problem which we have right now is that we have a huge legacy of conventional petrol and diesel vehicle, both in terms of manufacturing capability as well as in terms of the vehicles on road. So, do you think that petrol and diesel vehicle would have a limited shelf life going forward, or do you feel that we will have a coexistence of these two, in the near future, or maybe in the extended future
Yeah,
as well?
sure. So one thing before I get into the detailed explanation of it, my view on this subject is very clear. The share of EV will keep going up but the basic ingredient for that has to be actually come in place for the share to go up significantly, right? So that's very clear. But when we pay attention to the details, China, which is the fastest growing as far as EV is concerned, and the share in the mobility for China EV is again very high. So one thing is very clear: there is a big government push as far as China is concerned. And even if we dig deeper, so you will find that the initial big push up which has gone up as far as the purchase habits are concerned, you will find that this is more government related purchases, which is what is seen in the number. So and plus the third factor is some of the cities like Beijing, they actually, it's a regulated market. For you to buy a new vehicle, you have to have a license, and if you make it attractive, then people will go for an EV related vehicle. So heart and heart of it, consumer is, as I'll stick to the point, the buyer is looking for an affordable solution. Actually, of course he cares for the environment, but from his personal decision perspective, he will more look for a affordable solution, and which is where EV, the battery cost has to really come down for the consumers to make that choice. Today, obviously, it makes a lot of sense. Our discussion with a couple of players make clearly suggest to us it makes a lot of sense as far as India is concerned when the vehicle is used for the commercial purpose. By commercial purpose, I mean to say for the bus intra-city buses which run on a regular route, or for, let's say, Uber, Ola equivalent kind of companies which are again running maybe a significant number of kilometers in a day, for them to be breaking even or make it affordable. So I think again here I'll stick the point that from the personal mobility perspective, if you ask me, it would be first that the government run buses or even the private run buses which run on a fixed route, maybe followed by a three-wheeler kind of model or Ola Uber kind of model, and finally it would come down to a two-wheeler kind of mobility, which is the scooter equivalent of the mobility, and the last leg would be basically the car market. Again, when you look into detail about how the government has been encouraging, I think this is their priority. There again, there is very limited amount been reserved for the car owner. So that is my sense is the last one to move into this. But yes, gradually, even globally, it's happening, and more so in China, EU kind of countries. You will see the share going up, and also this share will go up because there will be, if not government push, it will be some of the code-driven push for as far as environment is concerned. So you will for sure see some move as far as this area is concerned, and both will coexist at least for next 2 decades.
So, Sachin, my next question is about something which Indian government is very sensitive about, and for economy to prosper, that is very important. That is foreign direct investment as well as mergers and acquisition of a scale which matter to the industry. So, we have seen auto as a good sector as far as that is concerned, because if you look at last couple of decades, we have seen around $25 billion of FDI in that segment, and we have seen good amount of companies setting up base in India, while an Indian company trying to acquire or acquired a company outside India in terms of expanding its product proposition. Uh, with Indo-China relations, which we touched upon in the first two questions, changing in terms of dynamics and certain MOUs being cancelled, and the growth also being a little lackluster in last few quarters. Do you think this trend will change, or do you think that FDI and newer set of companies setting up their base in India will keep on working the way it was for last couple of decades?
No, so your point is valid. So if you observe the data of how many players have entered into India in last 2 decades, you will find that almost all global manufacturers have tried their hands. They have set up capacity, so they have actually been committed. They have set up capacity. They have put money into Indian market, and maybe over a period of time they have found the cost economics not to be working, because essentially the problem in India is twofold. One, India market is a sub 4 meter market largely, which is where Maruti has actually, or maybe one of the larger player has actually got a good scale, and that's one factor should be to be kept in mind. So unless the market size actually goes up, the unit economics of some of the new players may not really work very well. Because again, see, from if you observe the market, two-wheeler and the four-wheeler market, two-wheeler market, you will find that some of the brand, it is very difficult for the new brand to get created. So people will keep buying the same brand again and again, because it's as we've touched upon this subject, that the buyer of a two-wheeler, and specifically the entry level buyer, is basically very he want to be very particular about which brand he wants to buy, because he doesn't want to try in the market, because he has only limited kitty with himself, so he doesn't want to try. So they go for tried and tested product, and which is where you will find that that market is very sticky with couple of brands within a few companies, and very hard. There are only been very few examples in last couple of years. So that area we have not seen any large manufacturers and manufacturer coming and trying the market. Now when you come to the four-wheeler market, again here, there are, again you have to look at in the two perspective. One, which is the sub 4 meter segment. Again here the buyer is again not very really willing to try too much. But beyond 4 meter segment, which is primarily now emerging in form of SUV, you will find that the buyer is willing to try out newer products, and that's where new players are, maybe all the two or three new players who have again come in the market. They are trying their market there again in that market. But one thing need to be kept in mind is that from the manufacturer's perspective, when he brings a car into India, uh, these people who are trying the new products, they will keep looking for newer and newer products. So basically the product cycle is very short, so you have to keep offering newer and newer product in the market for you to remain relevant, and every new top or every new product that you offer in the market cost you money. Now, the other important factor as far as this market is concerned, the most important piece in this is that you have to keep your dealer alive and survive. Other Unless that leg for the manufacturer works very well, they would not be successful. And for that to happen, they have at least 5 or 6 products which are actually running for them. Over a period of time, there is a spares and maintenance income which comes for the dealers, and this is how you create an ecosystem, which is where we found that many of the MNCs who have tried their hand have not been really successful. Except, so we all know that the leader is Maruti, followed by Kia, and then third player is far and distinct. So there is a big difference between even the market share of these two players. That's where the challenge is. But that's actually unlike in the other global developed market, where the maximum share is between 20 to 23%. But that journey to happen for the Indian market, we really need the market to expand before we actually. And once that market expand beyond, let's say, 5-6 million vehicle a year, that's when you will see the serious competition coming into the country.
A very valid point that market expansion leads to competition increasing and serious competition coming in, and I think that's relevant for all the segments and all the sectors. So that brings us to the end of this conversation, Sachin, and one last question that is about stock market performance, and that's where most of the investors who are listening to this podcast might have a lot of interest in. So if we look at April, May, June quarter, the auto index was the best performing index. If we look at since the lows of March, auto index is up more than 70-75%. But if we compare it with what it was in 2017, we are still 30-35% lower than that level. So though the recent history and the recent performance has been phenomenal as far as auto is concerned, but if we look at 3 years and 5 years picture, it's a very lackluster picture to look at. So for an investor who invested in this, say, 5 years back, what would be your message in terms of holding period and in terms of expected return? And what's your outlook on that?
Yeah. So my plain simple message to these investors is that there is a lot more room for the market to expand. As I have responded in the first question, is that from the global perspective, we are too small as far as the volume is concerned. And on top of that, our ASP is again very small. So there is a big room for the ASP to, that is the average selling price of the cars, or even for that matter, the two-wheeler journey, that premiumization journey is concerned. There is a big room for the entire sector. At the same time, because the penetration level are low in Indian market, again there is a big room for the market to expand. So which is where I continue to believe that this is a growth sector, as far as my view is concerned. And today we are maybe sitting, like I said, that FY20 was the worst year in last 4 decades as far as the volume degrowth is concerned. So maybe we will obviously have a catch-up game into this. So obviously there will be a medium-term time frame when you will see this catch-up playing up as far as sector is concerned. And associated with that, maybe after this current rally, we may all believe that the multiples have gone up and maybe the sector has gone expensive. But one thing we should keep in mind is that in last 2 years, because your volumes have gone down, your operating leverage has gone for a toss. And which is where you will find not just your operating leverage has gone for a toss, but your balance sheets are also not very well, because when you degrow, you have to pay back to your vendor, and which is where there is some bit of extra debt on your balance sheet. So your return ratios also don't look good. But similarly, when the tide also turns, you will find that there will be lot more operating leverage which will start to kick in, and at the same time your ROCs, the balance sheet, everything will start to look good. And that's the time maybe you can have a fresh look at it, what you should be doing with that. So my sense is that the sector continues to remain a growth sector, and you should be. And there are handful of established players in the market who are not looking for raising fresh equity capital. So that's another factor should be kept in mind, that this is not the sector which keeps diluting as far as the equity is concerned. So that's so these two things you should keep in mind. It's a sector with a high ROC play. And again, not just that we're playing on the auto OEM, like we said, that the entire gain in the average selling price will end up the indigenization or the change in regulation would result in multifold opportunity for the auto ancillary sector. So that's also another piece we should keep in mind, that that's the play which we will try to capitalize by investing in this sector. That's my message to the investors. So be invested.
That's very encouraging and that's very comforting because you mentioned that few established players and they are not looking at diluting the equity. And our experience with those established players has been really good as far as dividend payout is concerned. So it's been phenomenal for those kind of companies. With this, we come to the end of our discussion, Sachin, and a few key points which would be takeaways for us would be that, with GDP per capita improving, we would see a lot of premiumization in this and we would move from sub 4 meter to maybe high end cars. Collaboration is the key in this industry. Market size has to go up for economies of scale to play out and for serious competition to come in. One good thing which we have seen in India is the quantum of roads being constructed. And I think with roads getting constructed at a pace at which they have been for last few years, we should see more automobile sales, and that should benefit the entire ecosystem from OEMs to ancillaries to everyone, and not at the cost of environment though, because we are becoming environment sensitive and conscious also. Thank you so much, Sachin, for taking out time on a busy day, and I really appreciate the effort put in by you. And I'm sure the data points and the information shared by you would be of enormous value addition to our investors. Thank you so much.
Thank you very much. Really appreciate this call.